Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, AJ Brown. Good morning, AJ. Happy February 10th.
Yeah. Hey, Sip. Good to see you.
Went with the heart and the lovey feels for February here, right? We got Valentine's Day on Tuesday, and looks like all the fellas out there are gonna have some time to dedicate to their loved ones because it's been a slow market, right? This week, I feel like it's a battle between economic news, earnings, and what's your perspective from our last show in terms of the big rally from the Fed news, essentially?
Yeah. Well, there was some more Fed news on Tuesday. Not really Fed news, but remember, we've been talking about those three tools that the Fed uses, one of them being interest rates, one of them being their bond buying and selling program, and then their rhetoric. And so on Tuesday, Jerome Powell came out speaking to a group, and of course, everybody from the outside paid attention. And he basically said how hawkish he's going to remain on his bond selling tools. And that basically means that he's going to keep selling bonds. He said for the foreseeable future, for the next couple of years at a minimum. And so, that's one of the Fed's tools that, folks would like them to kind of chill out on. So, with that hawkish tone that he gave on Tuesday, it's caused some investors to kind of reconsider their current bull market. But I really think it's fleeting, right? They have these moments. They're like, but then they'll go back to buying as soon as things calm and that statement gets more into the past. We'll see.
Yeah, it seems like that's one of those headlines that the public doesn't get so riled up about versus like a rate hike, right? Like a lot of people don't understand bonds, so if they're using bonds as a tool, it's like we'll do it on the hush hush. But in addition to that, it's been like the earnings news, and the earnings news, from what I saw, is very mixed, and it's kind of leading to I don't know, like a not too much of a direction.
Well, it's mixed unless you dissect things by sector. So it's all about how you cut up the data. And so when you look at it by sector, there are definitely some sectors that are doing well. And then there's some sectors that are just kind of meandering along. And I hope that the Fed is paying attention to this as well, because, the Fed only has a couple of levers it can pull. And so if it's going by the overall market, versus like focusing on sectors, if it's looking at like sectors, it may decide that it's time to kind of calm things down and will let these hot sectors kind of run their course. And the sectors I'm talking about are specifically high-end retail, leisure, like leisure travel, things like cruise lines, airlines. This is a hot sector right now. People are just wanting to get out and see the world. Forget about what they learned 2 years ago with like a cruise ship might be a big petri dish for spreading disease. Forget that. People want out. They're tired of being cooped up. So that sector's hot, hot, hot. In fact, I don't remember last week we got those employment numbers that were just like through the roof awesome. It turns out when you look really close, most of the sectors that were hiring were just mediocre. But then when you get to this sector of like giving people trips and nice experiences, I mean, that they were hiring like crazy, and that kind of tilted that overall economic report to the hot side. So yeah, and then the last one is professional services that basically big companies use and rich people use, for like taxes, for estate planning, for business planning. that sector seems to be hot as well. But everything else seems to be moderating. And if you're in the goods market, not the high-end goods, not like your Tiffany's or your, high-end fashion, but if you're in normal goods, like, oh, give me 1 second here. My camera bumped out on me. 1 second.
Oh, all right. We'll zoom in on my face to kind of touch on that. Oh, we're back in business.
That's the benefits of doing this in real time here. The high-end goods things, are regular goods things. I mean, people are done buying stuff, and I think that some of those companies made some errors in during the pandemic, thinking that this kind of demand for stuff would continue. So a lot of those companies during their earnings calls have reported that they overbought inventory for the upcoming years, and now they've got a lot of inventory that they either have to carry over and hope that people want in the next couple of months, or they're going to have to liquidate at a discount. So those companies made some strategic errors, thinking that while we were all cooped up and had nothing to do, so we were buying stuff online, that kind of demand would continue. But if you're in the market for some stuff, now's the time to get good bargains.
Yeah, and I think another industry. I see that you pulled up the economic calendar, so maybe we could touch on some of those. But I've been hearing good news around the real estate industry, where it's not crumbling as fast as one would assume with such quick interest rates, and that's leading to some optimism that we won't have a crash. It may be a
Right.
slowdown.
Well, and remember mortgages, right? That's what kind of drives whether people are interested in real estate or not. Mortgages are not based on the overnight Fed funding rate, which is what the Fed has the lever with. Mortgages are based more on what the 10-year bond rate is. And so the 10-year bond rate, because of this other thing that the Fed is doing, the Fed is like selling these bonds, which is causing the bond market to be hot, which is attracting investors. Because if the bond market is hot, that's going to be like a magnet for investors. And now that you've got all these investors buying into bonds, that rate is actually moderating, right? It's the supply and demand type macroeconomics we learned about in our first year of college. It's balancing out. And so those mortgage rates have gone down off of their peaks, attracting people who were, resistant to high rates. They're now coming back into the market. And so real estate isn't like crashing like people thought it would be. In fact, real estate, unless you're in some select markets that may be overheated, real estate's seems like it's going to be doing okay unless something catastrophic happens.
Yeah, and that's probably good for the increase in housing prices over the past couple of years,
Hmm.
to get some new buyers into the market.
Hmm.
Do you want to run through some of these economic numbers at all?
I
But I
mean,
don't know if there's anything there to worthy of a.
here's all I've got to say, and that is around jobless claims, which was probably besides the kind of qualitative understanding of what Jerome Powell said on Tuesday. These these jobless claim numbers on Thursday were at some of their lowest. And so people, and I think investors are getting a little bit confused, right? Because I'm seeing that the market's been down for a couple days. They're a little bit confused because they think that just because these numbers are so good as far as the number of jobs, that the Fed is going to, stick with their crazy, tamping down of interest, tamping down of the economy. But when you dig down deep, yes, a lot of people are employed, a lot less people are collecting unemployment. There's more people going back to work. But if you look at wage growth, and again, you have to do it by sector, because if you look at some of those hot sectors I talked about earlier, leisure, high-end retail sales, and professional services. Those you got to kind of those are hot. But if you look at other wages, even though jobs are being filled, wages are moderating, just like prices at the supermarket are moderating. They're not moderating as fast, but they are moderating. So I think the Fed is having some success. If I had a magic wand and I was the Fed, I would look at these different sectors, and I would realize that these really hot sectors, this minority of sectors in the market, doesn't represent the whole market. And so I might make some decisions like that. I don't know if that helps, but I don't think that the economic news is as sour as the investors are interpreting. I think investors, because it's been so easy in the last years for investors to enter the market rather than going through like advisors, people can have direct access to the market, which is both good and bad. It's good because, we should all be able to have equal access to the market. What's bad is some of us don't have the insights and education to be able to make educated decisions. And so we kind of make decisions based on, whatever news sources. And we know the media is very tainted, and depending on, there's very few unbiased medias this day. So there's a lot of like whatever the media says, all of a sudden the market sways because there's so much people who don't have like the experience to do the in-depth analysis that they need to.
Yeah, I would also say that I can literally take my phone and make a transaction based off of a headline or a tweet or something. And if, people follow me, that's what moves markets, right? That's what determines prices.
Reddit, right?
And
GameStop, AMC.
that's right.
Perfect examples.
And at the end of the day, they are educated guesses, like you said, but you've been doing this for 20 years now, and you've developed a system that makes it easier, lowers your risk, and you started to go into a little bit on what the Fed would do. But before we continue on that topic, anybody that's listening, watching for the first time, this is the AJ Brown Show. AJ has been running Trading Trainer, a education program for over 20 years, teaching his strategies. And he's got this workshop, the daily workshop, where he goes over these 4 shortcuts on how to develop a strategy that almost functions like income, right? And so it's a wonderful webinar. It's free. I'm going to go ahead and throw that link in the chat. So if anybody hasn't checked it out, go ahead and check it out. We're going to take a little break. We're going to go through our trending topic. AJ is going to do his pick of the week, and then we're going to do our speed round. And in the speed round, we basically run through a number of tickers. And so if anybody watching has a ticker, has a position that they want AJ's opinion on, go ahead and throw it in the chat, and we'll try and run through it. Otherwise, we'll be back to talk a little bit more about the Fed. So stay tuned, folks.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, it's almost that time again. It's almost that those summer vibes, cruising through the streets. So we'll I mean, that's basically every day for me out here in California. I won't lie about it. But back to our discussion, back to what's going on in the world. And that's well, first off, I don't know if you saw some of the images coming out of Syria and Turkey, but that is extremely devastating. And that has to have some sort of an impact on the overall mood in general, because I saw at least 10 videos of buildings just wobbling and then coming crashing to the ground, and it was just like heart-wrenching. And I know they like paused the stock market, which I don't know how big of a stock exchange they have, but Do you think something like that has to have an effect on the overall world economy, sentiment, things like that?
Well, I'm going to be. I hope nobody, maligns me for being a little bit on the cold side. But as far as economies go, uh, Turkey and Syria probably have kind of a smaller footprint in the world economies, and so despite how gut wrenching this is, I'm not sure it's going to have much effect on the markets. It's not like they're not an oil producer. I think the headline that Russia is going to reduce its oil production is going to have more effect on the markets than the loss of human life in Turkey and Syria, despite how gut wrenching it is.
Yeah, I don't know if you've actually ever experienced an earthquake, but I have, and it's definitely a an eye-opening experience. And so I think we wish everyone in that part of the
Hmm.
world all the best, and we'll keep a positive light on seeing if there's anything we can do to contribute. Other than that,
Hmm.
in the U.S., right, we're having all the earnings coming out, and then the Fed basically, well, it was interesting. The chairman gave an interview, right? The
Hmm.
interview was like it wasn't even a release of news. It was just getting asked some pretty good questions. And
Hmm.
from that, um, those statements moved the market a little bit. And so our question for the week is, what would you do if you were the Fed? And so, AJ, what would you do if you were in the chairman's shoes at this moment?
Well, one of the questions, and it got reported in a Reuters article. So if people get a second to take a look at, and I'm going to pull this up really quick. Let's right here and bring it up over here. So there's this Reuters article out there. This is from Tuesday, a couple of years before the Fed nears its balance sheet decline. So we've talked about this a lot in our podcast here, which is basically the Fed took on, if I go back a couple of years here, the Fed took on a huge amount of debt. Not debt, but they basically created cash, and with that cash, they bought a whole bunch of bonds. They bought treasury bonds, they bought mortgage-backed security bonds, and just recently they started buying really high quality corporate bonds. And that has created an influx of cash into the markets, mainly to the people who were selling bonds. So now the question is will that money get distributed down to the everyday folk? But then at the same time, now they're on this spree of selling those bonds and shredding the couch. They're both selling the bonds and they're allowing some of the bonds that they've had through maturity to mature, turn into cash, and they're not replacing those bonds. And all the cash that it generates, it's basically now shredding. So they're taking money out of the market through the bond market, right? And out of the economy, I should say, through the bond market. So you guys got to remember that the Fed, they have these very coarse tools to put money in and out of the markets or to slow or speed up the economy. And they have like sledgehammers. They don't have like little intricate hammers. When it comes to like distributing the cash so that all of us can kind of get a little bit of it, or when they take the cash out, that it affects us equally. That comes down to what's called fiscal policy, not monetary policy. So the Fed has nothing to do with fiscal policy. In fact, those are your elected officials, your congressmen specifically, that get together and, in theory, democratically figure out how to redistribute wealth. And I'll tell you, anything where you put like 500 people in a room and you try to get them to agree on something, usually nothing gets accomplished. And so what you see here with when you look at what the Fed has done, you realize that the people, just look around your everyday life. I don't know if you guys have even thought about visiting places like amusement parks or going to even a Chipotle. You'll notice that the price of a burrito now is not even affordable by anybody who's not really like middle to upper class or higher, right? So the way that the wealth has been distributed, the people who are kind of doing much better than the rest of the people, they're spending. They're spending at their Tiffany's, they're spending at their high-end retailers. All the high-end fashion people are doing good. They're buying cruise tickets, they're going on airplane flights, they're vacationing, they're buying high-end meals, high-end restaurants. But the little guys like Bed Bath and Beyond, who sells, trinkets to just about everybody, they're not doing well. That's because people with the kind of middle to lower incomes, they're having a very hard time of it. And the scoop is we all vote. So there's a lot of angry people out there who are going to be voting, and they're not happy with what's happening with this redistribution of wealth, and maybe they don't know how to change that stuff. All to say, back to the question at hand, if I was the Fed, what would I do? I would probably, like I said earlier, realize this differentiation between sectors and more specifically between wealth groups, and start to moderate my policy based on the masses and not just the overall. Like, I would let some of these sectors like leisure travel and professional services, I would let them run, right? I wouldn't base my monetary decisions on those hot sectors, which are probably over affecting the overall broad market indicators. I'd make sure I'm looking one level down. And so I probably would not, if I was the Fed, I'd moderate on my interest rate hikes, maybe some quarter point rate hikes coming up, but I'd stop and I'd let the current interest rate hikes that I did last year soak into the economy. I'd probably stop. And then the second thing I'd do is I actually would keep selling the bonds and letting those bonds that mature. I think that that's a smart thing to do. I think the Fed needs to get out of the business of owning bonds. I think they need to go back to pre-2008. I think they need to get out of that business. So sell off, let these bonds mature that are on their balance sheet. Do it in a non-aggressive way. So I like the plan, and just keep doing that. And then they need to just shut up. In my humble opinion, they need to stop talking. I find that people have short-term memories. So right now, the Fed is getting looked at as uncredible. Just shut up and stay the course with like no more interest rate hikes after, a couple more quarter point. Get it to 5%, 5.5%. Stop. Keep selling your bonds behind the scenes. Nobody understands that program anyway. And then just shut up. Just let things work their ways out. And that's what I would do if I was the Fed. And then as normal people, I would focus on my congressman and just start writing a lot of letters about what you think should happen as far as fiscal policy goes.
Wasn't Alan Greenspan the best at like giving statements that nobody understood what he was talking about?
Yeah. He understood that, you just had to be cryptic, and then you just shut up. You say things in as few words as possible and just shut up and be behind the scenes. And so I think that's what this Fed, there's been all this, we want to know what these people are doing. Well, do you really? It's like, just shut up. That's all.
I feel like if they just went on pause for a quarter, 2 quarters, and we're just like, hey, we're letting the data come in, and then maybe make a statement or two that's a little dovish or a little hawkish. It's like you're gonna get the market effect that you want by a couple keywords without having to impose the new interest rates. I mean, I did like the curvature on that chart, right? It is starting to make its way down, and I know we did the show when this was like at its peak, and it was like, oh man, I can't believe that it's going up that high for that long. But now it's making some. So I would probably agree that it's better for them not to be in this business, but at the same time, they probably should chill for a little bit with the rate hikes. And
Yeah.
the public and the market should be okay with let's just let things be for a while. Like let's get to the summer, Okay, so that's AJ's opinion on what he would do if he was chairman of the Federal Reserve. Okay. So let's dig into the juicy stuff in the show.
Well, let's look at the broad market. Let's before we start looking at individual tickers, let's look at the broad market, Sip. So the S&P 500. So we got a confirmation that high close that we found on February 2nd was our high reversal. It took a few days to get that confirmation, but that was our reversal. And when we measured that reversal was perfectly in line for an ideal expansion phase in an uptrend. So now we're in a contraction phase of an uptrend. We really want to see it go somewhere into this center zone between about $4,006 to $4,072.50 in that zone. We didn't quite hit that with yesterday's close. Yesterday's close was at 4,081. So I kind of want to see it pull back another $10 before we start heading high again. That would be an ideal contraction phase, and it would support another expansion phase moving higher. And that's for us bulls out there. When I pull back a little bit more, like the last 2 years, sideways choppy phase. So even if in the short term I'm in this uptrend, basically I've got some real overhead resistance that I'm going to be coming up against soon. And I might just be comfortable doing what we do here best at Trading Trainer, which is selling premium. Selling premium is just a great way to make income when other people can't figure out whether the market's going up or down. And then one last thing is we like to look at where people's kind of uncertainty index is. So we look at the VIX. Well, the VIX is coming off of its lows. It's formed a bottom here, which means people are starting to get a little bit more confused or uncertain again. This is a great time to hedge our overall portfolio. We can do, some spreads on the VIX that could otherwise, if people just stay status quo, it'll break even, maybe make us a little bit of profit. But should something happen that freaks people out, and causes some of our other trades to go sour on us, we could put a hedging trade here. I've talked about it in the past that would compensate for any losses we have in our other portfolio. Now's the time to be thinking about putting this particular type of trade on, a hedge against your overall portfolio by basically hedging the VIX.
Well, that's the beauty of your trading style, AJ, is any chart we pull up, you've got a way to approach it, up, down, sideways, no movement, no volatility. And that's why you've been able to run such a successful program for 2 decades now. And so if anybody's watching, listening for the first time that is kind of on the fence, hasn't really taken the leap into investing using options, maybe you've checked out the webinar and you're still not sure, AJ's got a wonderful one-on-one program where you can come in, ask all those tough questions, get the attention that you need. And if that's something that you're interested in, feel free to jump over to the link that I just added in the chat. Scroll down, schedule an appointment. I guarantee you it will not be a waste of your time. You will learn something. You're not going to get sold anything. It's really just to give you the best opportunity to succeed on your end, because AJ's been succeeding for a while now. Got a lot of students that are succeeding. And so here's a nice little way for you to get in on the mix. All right.
I like what you just said, where you said if you want to be an investor, because investors, I feel like, have a more holistic view of their portfolio, and their main goal is to have their portfolio grow versus like a trader. A trader, I feel like, is a dabbler, somebody who gets in there, plays around, maybe makes a trade, but really, loses sight of the fact that as an investor, you're thinking holistically on your whole portfolio, and that portfolio should grow at the end of the year, not just by little trades here and there. Traders tend to be too focused on the infinitesimal versus investors.
Yeah, and that's the beauty of options. Options kind of give you that ability to
Absolutely.
look a little further out and not be so so stuck to the screen, as they say with traders.
Mhm.
It's like, this happens, we've got a plan. If that happens, we've got a plan. Let's look for some opportunities.
Yep.
And that's what we're going to pull up now. And so AJ's looking at the markets all week. We've got a slew of traders in the program that they're bringing up tickers. And so today's AJ's pick of the week is Riot Platforms, ticker symbol RIOT. I feel like we recently went over this one.
Yeah, this one was brought to our attention by one of the folks on this show. They wanted me to take a look at it, and after the show, I actually started doing some more research on Riot because I was like, "This is something interesting." So I actually looked at it from a fundamentals perspective. I looked at it from a technical analysis perspective, and I looked at it from how I could trade this with option strategies, and I like it. This is a company that is really investing in crypto mining. So whether you have feelings about that or not, but they're currently at this kind of top reversal. And so I'm looking at this. I made a trade plan on this. This is what I teach my program participants, whether they're working with me one-on-one or if they're in the overall. I created a trade plan on this in order to do some premium selling on this. So right now we're at this top reversal, and I'm looking at legging into a bear put diagonal debit spread. So let me explain that a little bit.
Wait.
At
Say that
yeah,
again. How do you say that?
yeah, bear put diagonal debit spread. Legging
Ooh.
in, meaning I'm going. Yeah, I know. Meaning I'm going to do each piece on a different date and time.
Okay.
And so I'm going to start with this January 2024 put option. And I'm going pretty deep in the market. And you'll notice that this particular candidate, if you look at the bid-ask spread, it's only a couple pennies, even with these options all the way out to next January. $1.25 to $1.30, $1.02 to $1.06, 83 cents to 85 cents. These particular put options, and if we go deeper in the money, 1755 to 1775. So I'm going to be doing a far out in time, deep in the money put option. And so what this thing is going to do is it's going to profit if the underlying symbol goes down. And since we're at a top reversal, I fully expect it to go down, right? So I'm going to set that trade up when I get a nice solid signal. I did get a signal over here about 3 or 4 days ago, but I'm not sure that I got the good follow through on that yet. So I'm still paying attention. I'm actually, and I'll give people a little hint here. When I'm dealing with a ticker that's fairly new to me, I'll actually paper trade it for a cycle or two to see how the paper trade works out before putting my real money in. So I like to build confidence in following these patterns. So looking to find out if this is a good time to buy the deep in the money far on time put option. I'm going to let that ride. This is where the legging in comes in. And then once I have found kind of a bottom, in other words, once this thing bottoms out, and I expect it to bottom out somewhere between maybe $3 and $4, what I'll do is I'll sell my premium and buy my protection. So I'll sell a near term at the money put, and I'll buy a call that's really inexpensive up here with a strike price maybe around $7. That is just an insurance policy, just in case this symbol starts to work against me. And now with a sold premium probably around the $3.50 range and a bought protection, I have this trade zone SIP that will automatically adjust if the underlying symbol goes in either direction. It'll take care of it passively. So this is where me being an investor, I don't have to do anything. Once I set up that trade zone with those 2 option cells, I don't have to do anything. This trade will take care of itself. And if it stays within that zone as expiration comes, I start making an income off of it. So that's how I leg into a bear put diagonal debit spread. And I'm investigating Riot for just to do that, to start that process of legging into that bear put diagonal debit spread.
And with it being the stock price being under $10, right? That makes it a pretty affordable position to put on.
Yeah. If remember with options, we're going to be doing everything in lots of 100. So when you see, for instance, that you're buying something for $8.10, that's actually $810. But for most people's portfolio, they can afford $810 and the amount of risk that comes along with an $810 investment. So you're right. Because the underlying symbol is low in price, it makes it available to quite a few investors, even if they have the smaller portfolio sizes.
And because it's 2, doesn't that price come down a little bit, right? Because it's 2 positions.
Mm-hmm. Yeah,
Beautiful.
absolutely. So you're exactly right. Once we buy this, we're now going to get a credit when we sell the near term at the money option. We'll be able to get some money back. And so it makes the overall cost basis even lower.
And that's kind of the core basis of why you would use 2 options, is because you kind of give it that trade zone. And I think you drew that very beautifully on the screen there, because it really does help tell the story of what you're trying to do. It's not like one arrow going up, it's one arrow going down. It's like, we just want to stay in this area here, and we
the
know what our
beauty
risk
is if it doesn't stay in that area, that's fine. The trade self-moderates. That's the beauty of using options this way, is that the trade will take care of itself. I don't have to be there like doing all these defensive moves, stopping my life, telling everybody, hey, while my kid is learning swimming lessons and perhaps drowning, can you just freeze right there while I do this trade? None of that stuff. None of that anxiety creating like lifetime stuff that some of these day traders have to go through. These positions moderate themselves. I just have to come back and see how it works out at the end of the day. When like I'm in my lounge chair with my feet up, I'll just have my laptop and I'll be like, oh, that happened today. Cool.
And there's so many opportunities because there's so many different names to trade. And I don't know, we must have gone over hundreds of them on this show alone. But that's what we like to provide and give everyone an opportunity to chime in on. And so we'll just dig right into the speed round now. So throughout the week, we've had some people, some followers, some members throw out some names, and AJ is going to give his opinion. So let's start with the heart of America, somewhere there in the middle. Janet from Oklahoma City, Oklahoma. She's looking at the financial sectors ETF, ticker symbol XLF, which we've covered on the show before.
Mm-hmm. Okay, you'll hear a lot of gurus who love ETFs, but I'll tell you something. I'm not the biggest fan of ETFs. Don't get me wrong. I trade options against ETFs all the time. But here's the scoop about ETFs. They're a basket of other securities, usually stocks, that is not managed by a human. It's usually just set percentages of each stock. So when you buy a share of an ETF, you're actually buying like 0.5 shares of this stock, and it usually matches some sort of index. In this case, XLF matches the S&P financials sector. So when the financial sector goes up, this has the same sort of mix. So all well and good. The problem is when I'm investing and trading options against a company, right? I can look at that company. I can look at dividends. I can look at earnings. I can get an idea of what that company's doing, and I can make, strategic decisions based on the health of that company. When I'm looking at an ETF, it's not one company, right? It's a sector. So now what affects a sector? Well, now we're starting to get into more of this speculative news headlines around financials and all, because you could have a couple of companies in the financial sector do really crappy and they'll bring the whole ETF down. Or, so I get a little bit antsy around ETFs just because I can't get a good read on them like I could if I'm doing some research on a company. So that's my little spiel on ETFs versus equities. I would way prefer an equity, an individual stock. And that's kind of counterintuitive compared to what a lot of gurus say who trade only on the ETFs and stuff like that. I'm the opposite. Give me a stock any day that I can research who the CEO is, research the board of directors and what kind of insider trading they're doing, and I'll feel much more confident in putting option strategies on them.
Can I ask a
With the,
quick? Would it be safe that option there's some ETFs that have more option activity than others, and this is one where the ETF does have the options component?
Yeah, the scoop is that the patterns that we trade against, and ETFs get a lot of activity, not just on the ETF, but in the option chain. So the other thing you got to balance it with is that liquidity. And so there's so many options traded on this particular ETF. And so that kind of makes it, you got to balance these things with your decision to trade against these. So it makes it more favorable that there's so many people trading options against this ETF.
So it looks like we're hitting resistance here for if I'm looking at the chart.
You're absolutely right. We see basically a tested line of resistance, and people have to remember that when you're looking to do any sort of options trading, it is important that you identify what the pattern you're actually seeing is doing right then and there, because if you don't identify that right, then you can't apply the right option strategy to make the most of that pattern. So sometimes you have to pull back a little bit and you have to see what is actually going on. So I see that you're exactly right. We've got this level of resistance that over the last year has been tested 1, 2, 3, 4 times. I'm a little bit less confident about where support is, right? So support might be down here. I see 2 nice tests of that. I don't see that we have support here, even though that's where we went to this last time, because again, you might have heard me just say it. You need to have at least 2, if not more, tests of a level to really call that a level of support. So this might be just kind of an afterthought. We'd have to see this one more time for us to go back and redefine our whole strategy around 34 to 37 versus 31 to 37. So with that said, Janet, I would probably look at a 31 to 37. And because I had kind of this fake out in the end of December, beginning of January, I'd want to see that I'm truly on my way down the channel before I'd do any sort of trading. But this is setting up perfectly for what we were just talking about on Riot, which is a bear put diagonal debit spread, specifically to leg into it. So that means doing the back leg first, waiting, and then doing the front leg and adding on some protection when you get your bottom reversal. So I think you've got that. And like Sip was hinting at, if I come over here to the option chain, this, ETF, I mean, got tens of thousands of contracts, bid-ask spreads of only a penny. You're not going to have any problem being able to transact this, whether you're doing a lot of contracts or even just one.
All right. So that's XLF. Thank you, Janet. Moving on to the Northeast. Drew from Norwich, Connecticut is interested in Pan American Silver, ticker symbol PAAS. It's a new one. I think this is a new one for us.
Well, it's a new one for us on our show, Sip, but I've been trading options against Pan American Silver for about the last decade. So this is one that I definitely like a lot. I think I even have featured this in some of my complimentary workshop webinars, like the one you advertised in the beginning of our show here. So let's go back 2 years And so Pan American Silver, they're a mining company, but they want to have such a monopoly on silver mining that they actually are the way that equity traders can get into the silver world. So they want to represent the demand on silver. So as you can see here, we seem to be in a sideways pattern since about September of last year between this $14 and $18 range. So I think we could totally, I like the idea. And I like that Pan American Silver, despite at this point in time, because of silver prices being so low and things like that, they're basically breaking even as a company, but they're making sure that they pay their investors a pretty nice dividend compared to the price of the stock. So what that tells me is, number one, they're a company that plans to stay around for a while, so you don't have to worry about that. But that also the investors behind Pan American Silver, they're not nearly pushing on the company to make profits because they're getting that nice dividend check. And so for us option traders, this is like a target company. By the way, silver is kind of boring, especially right now. So that also makes me excited to sell premium on it because I can make this into an income generating investment using option strategies. And so indeed, this company has hit a top reversal. I'm a little bit I'm looking at the previous earnings, and it doesn't look like the investors are phased too much by the earnings. There is a earnings call and an earnings release on February 23rd. It may be worth your while, Drew, to wait until that earnings comes and goes before you get excited. You could go back a couple of shows, watch the replay from a couple of shows, and see if one of those earnings trades might work on Pan American Silver for just the short term. Do one of those overnight trades before the day before and the day after the earnings and see if you can do something with that. But in the meantime, for a premium trade, I'd actually hold off until the earnings, and then I'd probably look at how I could either do a covered call or even get more elegant and do a bull call diagonal debit spread. Bull call diagonal debit spread, just a variation of the covered call. That's all.
And if you want to learn a little bit more about the terminology here, I know AJ's got a wonderful education portal in the Trading Trainer membership area. I forget what it's called, the university, let's just call it. So if you want to get a little bit more insight on all these technical terms, do go to the site tradingtrainer.com and sign up there. Moving on, staying on the East Coast, and this is going to be touching on kind of what we discussed with the earnings, the hot sector. And this is Dan from Charleston, South Carolina. Host Hotels and Resorts, ticker symbol HST. I mean, they got to be doing well, right?
Well, and interestingly enough, this also talks on what you brought up, Sip, which is a REIT. This is a REIT. This is a equity that funds a real estate company that buys these properties, these hotels and things, and then they're run by other companies like Marriott and Hilton. So this is the actual landowners and building owners, right? So that focus on buying, renovating, building these hotels that are then run by the main chains. Like I think Host also likes to focus on the high end, like Ritz-Carlton. So it's hitting a bunch of those things that we talked about in the beginning of the show. I love it.
So it's more of a real estate. It's more in line with real estate than hospitality.
Both. I mean,
Okay.
It's real estate, but it would only do well if hospitality was doing well because they basically let those hospitality companies run their buildings.
Okay, that makes sense.
Yeah. So I know it's convoluted, right?
You need one and the like. You can't do one without the other, right?
That's right. One of the, like a Marriott or a Hilton, a lot of the buildings that they're actually running their hotel business in, they don't own. They just kind of, rent from one of these REITs that owns the actual physical properties, and they run their business in it.
And so, the REIT, and when you say REIT, it's like trust. It's like a different formation of the share like objectives versus like a tech company or something.
Right. So a REIT is where, like, for instance, a group of folks decide that they want to invest in real estate and they actually make the REIT available. A lot of them will go public. So when I buy a share of this, I'm basically buying a share of this company that is then going to go use my shareholder money to invest in real estate.
So we're looking
Specifically with this company, they're going to invest in real estate that's in the hospitality world.
So real estate in the hospitality world that's formulated in a trust that's in a publicly traded market
That's traded
where
on the
where
equities
stocks
market.
can be bought, and now you can layer the options on top of the stocks. Okay, let's see what you got to say about HST here.
So I love this 6-month chart. I love the dividend. I love the positive earnings. Everything about this company, about this stock chart. I love the clear signals by my fast MACD, the technicals. I absolutely love who brought this. Dan from Charleston. Dan, I think that this is fantastic. And I absolutely love where this is right now, forming a top. This is a great time to set up our initial covering position of either a covered put or a bear put diagonal debit spread. Let's do one more check and let's take a look at the option chain. So I'm going to look at the near-term options. Okay, so this is the only thing maybe I don't love is there's not as many people trading options against this REIT. There's enough, but it's not going to be like I can walk into the room and say, let me buy or let me sell my options and have people immediately take it off my hands or immediately put it into my hands. I might have to do some waiting for some orders to fill because it's not as active a market as, say, for instance, we just saw in that ETF or even in Pan American Silver. But other than that, I mean, this is I would be looking to jump into this with the initial step one trade of a premium selling position. And if I had been watching this, a couple months ago, like end of December, beginning of January, and I had bought some of this stock or bought some of those back month call options, now would be the time that I would be setting up that trade zone by selling a call option, maybe with this $19.50 or $19 strike price, and buying some put protection with maybe a $15.50 or $16 put. So depending on where you are in the pattern, this is a sideways stock. So whether we use puts or calls, it all depends on what's coming next.
All right, Dan in Charleston,
like
South
it.
Carolina, HST. I don't think that's one that we've covered in the past. And that'll do it for the show. I think we've gone through a lot of the what's been happening. We've got the hearts, the lovey-dovey vibe for Valentine's Day next week. But before Valentine's Day, we're gonna have the Super Bowl this weekend. That's always an exciting time in the country. And any final thoughts? What should we be looking? We've got options expiration coming up next week, right? Anything else that should be on our radar?
I think that we're going to watch and see what happens. We're not going to have a Fed meeting until end of March. We've got a holiday coming up, President's Day, not this Monday, but next Monday. Yeah, I think we're going to continue to watch earnings. I think that we need to start looking at sectors. I think you need to look at sectors. And I would say to all my folks, if you're going to spend a couple of minutes over the weekend kind of pondering what's happening in the markets, look at sectors and imagine, based on the sector, what type of avatar, meaning what type of person would be catering to this sector. So, for instance, leisure and hospitality. Who is the type of person? Where are they in the economic demographic? Where are they in, get a clear picture in your mind of who that is. For professional services, is this going to be a business? Is this individuals? For things like durable goods, like washers and dryers. Who's the customer for this? For fast food, get a clear avatar in your mind of what they're doing, and then think about how that avatar is spending their money right here, right now. It's going to give you a lot of guides on how you should be treating these different stocks, right? So I think taking a moment and looking at your watch list and figuring out and this is exactly what I'm going to spend the weekend doing. I've been postulating this for like the last 3 days about what I'm going to be, how I'm going to be thinking about things. And this is what I'm doing. Look at it from a sector viewpoint. I think that's going to benefit us all. And we'll talk about this in probably in the next couple of shows as well.
Well, I'll be honest. I'm gonna be rooting for the other AJ Brown this weekend. I'm going with the Eagles. I mean, everyone can kind of root for their team, but I'm going with the Eagles. So it would be great. Or imagine if he catches the other AJ Brown catches the game-winning touchdown in the last 3 seconds.
Hopefully that some of that good kudos will come to this AJ Brown, right?
Be like, they're going to be wanting to get you on the Good Morning Show, and you're going to have to let them know that I'm the other.
I'm the
I didn't
stock
catch
trader.
I didn't catch the touchdown.
Yeah.
But we catch different types of touchdowns every week.
Just the better ones, if you ask
not
me.
football touchdowns.
No.
All right, AJ, thank you for your time. Everybody, thank you for tuning in. We've appreciated the broadcast. We appreciate your time. If you've enjoyed the show, the stream, hit that like, hit that follow, hit that subscribe button. And we'll do our best to hit you with fresh content weekly, daily. Hit the follow button, hit the subscribe button. Ask the questions that you need to in the chat, in the DM. We'll get back to you as soon as we can. Otherwise, we'll catch everybody next week.
Take care, everyone.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.